silver has positioned itself for another huge bull market, even if it's, had a correction in the first breakout of that bull market. So gold prices are going to hit new record highs, if not this year, next year. And the same with silver, probably. So, I would just be buying the pullbacks.
And if we get a repeat of this, then, I mean, think about this, $250, $500 silver. I'm not going to pretend to know that yet. I'll have to get closer, but isn't that fascinating? So essentially over here, folks, what we're doing here is we're saying, maybe a little bit of a move like this, and then we get our last move down, then a lot of sideways kind of choppiness, and eventually we start our next leg up.
Precious metals are demonstrating extraordinary underlying strength as global markets face escalating fiat currency devaluation and mounting economic uncertainty. Smart investors are actively tracking gold and silver as essential defensive allocations against systemic financial instability. Peter Schiff, a renowned economist and financial commentator, alongside Gareth Soloway, a master technical trader and chief market strategist, project an explosive secular bull market for precious metals. Schiff asserts that gold is mathematically guaranteed to break out to new all-time record highs within the coming year, with silver following an equally aggressive parabolic curve as paper currencies erode. Soloway highlights key structural chart patterns confirming this macroeconomic trend, warning that market participants holding unbacked fiat face mounting debt default risks. Both experts predict that short-term price pullbacks should be aggressively accumulated as rare buying opportunities before the global monetary system encounters a severe currency crisis. As central bank inflation policies fail, physical bullion will remain the ultimate safe haven asset. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Look at the loss of value of gold and silver without appreciating the big gain that preceded that loss. Even though gold is down again today, we're still above $4,000 an ounce. So up until a few months ago, that was a very high price. So the fact that gold is not 5,500, I think is a lot less significant than the fact that it's at 4,000. And the same thing with silver. Silver, yes, it's not 120, which is where it got, but it's 57 and change. So it broke out. I mean, for years and years, silver was trading around $20, and maybe it can get up to 30 and it would come down. So all of that overhead resistance has now been cleared out, and silver has positioned itself for another huge bull market, even if it's, had a correction in the first breakout of that bull market. I think investors were a bit disappointed in the way gold reacted to the war. Again, ignoring the fact that gold went up before the war started. And part of that rally may have been the anticipation of the war. And so it was a buy the rumor, sell the fact. And now you've got gold traders spooked by all the tough talk coming out of the Fed and about how now there's a new sheriff in town and he's going to be real tough on inflation, unlike his predecessors. That's all BS. That's just this talk. He's trying to buy some cheap credibility on inflation by just talking about how tough he's going to be. But, even when he was asked in the Senate in the hearings the other week, what are you going to do about high inflation? How are you going to bring it down? He had 3 policies, and they all amounted to talking about it and doing nothing, because the Fed can't do anything but talk, and the markets will figure this out. So gold prices are going to hit new record highs, if not this year, next year. And the same with silver, probably. So, I would just be buying the pullbacks. Well, I don't really have a target, because I don't think that gold or silver have ceilings, because I don't think the dollar has a floor. The dollar could lose all of its value, in which case gold and silver prices would be infinite when you priced them in something that was completely worthless. But I just have a price target of higher. I think that you'll need more and more dollars to buy the same quantity of gold or silver. And so to the extent that you don't want to spend or invest your dollars today, you want to save to potentially invest or spend in the future, you should not hold dollars. You should hold gold or silver instead of dollars. And the same likely applies to a lot of other fiat currencies, like, you're in Europe. So, I would prefer gold and silver to the euro.
Silver continues to kind of languish here. You had this kind of down move, sideways, 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 and break, and now sideways again. And it continues to signal weakness unless we take out this level here. Okay, now what I wanted to show you on this is if we take away these trend lines, right, and we split the screen and we look at the various cycles here. So here's our current cycle on silver, right? Our blow off top, massive blow off top. And I kind of did this for gold last week for you guys, but it is fascinating to look at silver. If we go back on the cycles, right, and we go all the way back here, let's go back and we look at our 2011 cycle. This is fascinating. It is very, very, very similar to what we are seeing in silver now. And because of that, it can give us some insights into potentially where we're going in the near term. Okay, so let's go through this here. All right, so number one, you have the bull move with the little check back, and then the bull final move up. And if we look at this current cycle that we just went through in late 2025 into 26, it checked back and then it went up. All right, so this was in 2010 into 2011's peak on silver. Okay, so we have that. Now we extend that out and we say, okay, well, initially we dropped, bounced, and then we came down. And here you did have a much more just steep. I mean, you had this little bit of an uptick right here, and then the down move came down here. So similar, this had a little bit more of consolidation going on before that flush out. But either way, you ended kind of in alignment here, right? So in other words, you can see how, and I'm just going to clean up the chart a little bit here so we can keep it simple, is that essentially what we started to form was this base plate right here in basically in 2011 to late 2011 into 2012, etc. All right, so the point is right here. There's your base plate. And then what we could see here is you literally had the same thing. So you had the flush. So here's our flush, bounce, flush, and then bounce. And here you have your flush. Oops, let me do that better. Flush, bounce, flush, bounce. And notice how it's all going along this zone here, right? And here we have, at our current levels, we have the same thing going on. Look at this. Here's your flush, bounce, bounce, flush, bounce, break. And then look at how, just like here, hitting it over again, break, and then it goes to a retrace of the scene of the crime. You hit it here, hit it here, hit it here, broke, retrace to the scene of the crime. Now, what that tells us is that this peak here is the equivalent exactly in the cycle of this peak right here. So then we're getting close to where we currently are on the peak, right? So let's move this out. And what we see here is that almost identical, you get this move up, you get this move down, you get this little move up, then you get this little move down. And if we look at that, here's your move up, down, up, down. This is right where we are now in the cycle. And so what we see here is there might be a chance at another little bounce, right? There was a little bounce here. And then what happened to silver? It had its next leg lower. And that's the leg lower that, in my humble opinion, is going to take us to that $50 potential target. Silver likely has a little bit more downside, but if we zoom out, generally this became, I think we went a little bit lower overall, and it took some time, but that was essentially it. Like if we look at this is kind of that last dip to 50 or maybe just below 50. And then, yeah, you had a flush here. This was COVID. I'm not sure, we'd have to say, oh, well, you have to have another COVID to kind of do that. I don't think that's going to happen, in which case this becomes the long-term low. And then we start our next bull move that started in 2021. And then, listen, I mean, and then there's the history of it, right? And if we get a repeat of this, then, I mean, think about this, $250, $500 silver. I'm not going to pretend to know that yet. I'll have to get closer. But isn't that fascinating? So essentially over here, folks, what we're doing here is we're saying, maybe a little bit of a move like this, and then we get our last move down, then a lot of sideways kind of choppiness, and eventually we start our next leg up.
Detailed technical analysis reveals striking chart similarities between current silver price action and its historic bull cycle peak in 2011. Despite recent pullbacks in the US dollar index from 101.63 down to 99.78, Treasury yields surged significantly, with 10-year yields hitting 4.72% and 30-year yields breaching 5%. This rate spike triggered temporary price consolidation across precious metals. Current technical indicators suggest silver could experience one final corrective dip toward a primary $50 support target, with ultimate downside risk limited to the $35 to $36 liquidity zone. However, chartists project this short-term flush will mark the final capitulation phase before a multi-year breakout, eventually catapulting silver prices toward long-term price targets between $250 and $500 per ounce. Now, let's get back to the interview.
Let's start with gold. And gold is fascinating because last week we saw this mega drop in the dollar, right? Basically dropping from 101.63 on the DXY all the way down to close the week at 99.78. So that is a big drop when we're talking about the US dollar against a basket of currencies. You would have said, oh, well, gold and silver must have ripped higher, right? But then you look at this and you're like, wait, so in those 4 days, when all was said and done, gold was basically flat. Look, down, up, down on gold. Now, most people will look at this and say, well, that's bearish. And I would tend to agree near term, but I think the culprit here is that yields continue to go higher. So if you think about it, and a lot of people don't really understand the coordination of how yields affect gold. And the idea is that gold generally doesn't give a return. The idea is you're buying gold with the assumption that it will grind higher over time as fiats are printed. When yields go up substantially, it's putting up competition for gold, right? So, for instance, the 30-year is now at highs not seen since 2007, above 5%. So you can get a 5% return every single year for 30 years now. And the question is, people are saying, well, can I get that in gold? Will gold appreciate? Now, I think the key here is people's miscalculation. Because if we look here at the 10-year, right? So the 10-year is now trading at 4.72%. You have to look at this and say, well, what is the systemic issue here? Is it just that the economy is so amazing that rates are going up? Or is this telling us that the long end, people don't believe that the fiscal responsibility is going to come through? In other words, does the U.S. government or has the U.S. government lost total control of fiscal responsibility? Will debt just continue to go up? Is the debt level and interest payments so big now that we're just going to have to print fiat to pay off our debts? In which case, if that's the reason why yields are going up versus a strong, sustainable economy, then that is unbelievably bullish for gold and potentially silver. Do you guys see what I'm saying there? Kind of a unique angle that most people don't talk about, but I think that is what's going on. Now, again, for me, I already have my long-term holdings in gold and silver. I do want to buy more, but I'm being a stickler for price. So I need it to come lower. And again, if the masses don't understand this disconnect of what I just explained, then I think gold and silver still can go lower. Even if I miss the trade, that's okay. I have my long-term holdings. So if we look at gold here, it did try to break out of this downsloping wedge channel trend line or trend line here. But obviously what we saw is it creep up, pierce, and then got rejected on Friday. And again, what was interesting there is on Friday, we actually saw the dollar neutral to negative and gold still pulled back. So what we're watching here is, does it continue down into this level, or do we finally get a breakout here? Now, even if we get a breakout, history has shown us that a lot of charts will go like this, and then they'll kind of come back in and settle in and kind of come back to test the scene of the crime. In fact, that's one of the classic plays in technical analysis that I look for, is I want to see a confirmed breakout, but I don't chase the breakout, because once the breakout's done, sometimes you have already priced up substantially. And so I wait patiently, and I would say about 8 out of 10 times, we get a retrace into that key level here, which can become the buy, right? And again, if you extend this out, you could even ask yourself, is that then down at that 3,900 Pierce level, which is that next key support, or is it even lower? Now, that's just one scenario. The other scenario here, by the way, is that we could end up just coming down here and even piercing and getting as low as 3,600, which is my low end max downside target.
China is a key factor. I mean, they're a major producer. They're a major creditor. They're the second largest creditor nation in the world behind Germany. They'll soon be the number one creditor nation. They're the largest manufacturers. So the Chinese economy is going to dominate, the 21st century. I mean, America dominated the 20th century, but we won't dominate the 21st. I think the biggest problem for the world is the fact that I think the U.S. dollar is going to lose its status as the reserve currency because of the unsustainability of the U.S. fiscal position, both its current account deficits, its budget deficits. I think all this is going to be coming to a head. I think the markets are dismissing the likelihood of such an event. But I think a sovereign debt crisis and a currency crisis is the main looming problem that the financial markets, the global economy are going to be confronted with. And for a lot of countries, ultimately, this is going to be a very good thing. It's long overdue. But the initial reaction, people are going to panic when this happens. China probably has a lot more gold than they let on. And they probably want to buy a lot more gold than they let on. They're doing that for a reason. They understand that the dollar's days are numbered, and they want to position themselves to basically take that position. They want to have the dominant economy. They want to have the dominant currency. And the way to do that is to have the most gold, to have a currency that's backed by something, because that would be a viable alternative to the dollar, because the dollar is backed by nothing. So if, the dollar used to be defined as a weight of gold. Now it's just, paper. But our economy doesn't support the dollar's valuation because of our lack of productivity. But China's does. China has all the savings and production that we used to have.
Global financial dominance is undergoing an unprecedented structural realignment as international monetary power shifts toward tangible, hard assets. The core catalyst behind this macroeconomic transformation is the mathematical collapse of soaring U.S. national debt, expanding budget deficits, and continuous money creation. A massive sovereign debt crisis and widespread currency collapse are predicted to overtake Western economies, fundamentally dismantling confidence in paper-based financial assets. Consequently, unbacked fiat paper will suffer a rapid loss of purchasing power, inevitably stripping the U.S. dollar of its long-standing global reserve currency status. Simultaneously, Eastern economic superpowers are strategically positioning themselves for this new financial architecture. China is projected to dominate 21st-century global trade by utilizing its massive manufacturing capacity, strong international creditor position, and undisclosed physical gold reserves. By systematically accumulating gold bullion, foreign central banks are preparing to launch viable, gold-backed currency alternatives to bypass the vulnerable dollar standard. As global confidence in Western banking institutions erodes, institutional capital will aggressively flow into physical gold and silver. This historical monetary reset will trigger a massive global wealth transfer, driving precious metals to record shattering valuations while reshaping international commerce forever. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.